All right. Looks like I'm live. Got it. Admit. All right, boom. I'm gonna hop off and hang up with you. So let me adjust the view real quick. Speaker, gallery, immersive. What is that? Just wondering. What the heck is that? What is that? Immersive. Oh, geez. Zoom got some new stuff in it. Can you hear me? I can't hear you.
Oh, yeah.
There you go.
Yeah, that was the background music. I was listening to the podcast.
Listening to whose podcast?
Secret to Success.
I got you. You said listening to the podcast, like. So what you got going on?
Not too much. Waiting on the babies to get out of practice.
I got you. I'm gonna see real quick if I can't pull up my chat. I always have a hard time doing this. Let me see real quick. We are live though, family. If you're here, I can't really see what's going on YouTube right now, just because I'm not looking at the YouTube screen. But we about to get started here in just a few seconds. Pop out chat. Let me see this here. I think that'll work right there. Yep. All right. Let me go back to Zoom. And let me pop out the chat here. Yeah. All right. I need to make the chat screens a little bit smaller. There we go. Beautiful. Beautiful. Now I can see the chats, and I can see you, and I can see me, and I can hear you, and I can hear me, and I can. Beautiful. Yeah. So, got a few people that just just saying hello in the chat. If you guys are here checking us out on YouTube, definitely drop in the chat and say hello. 1011 Trucking says, greetings. I'm a licensed insurance professional and would be happy to chime in on the subject. Have you seen the title of this broadcast, Majida?
Yeah.
Gotcha. So yeah, 1011 Trucking says he's a licensed insurance professional. 1011 Trucking, that is who my guest is today, a licensed insurance professional, correct, Majida?
That is right.
That is who my guest is today. So I appreciate you being here at 1011, but that's what we're going to be talking about today. The benefits, the living benefits of a properly structured indexed universal life policy. Okay. Chris Hopkins says, sup, everyone. Appreciate you being here, Chris, man. Appreciate you following the content. Joe Good 42, you're live, homie. I appreciate you letting me know that, Joe Good. And maybe Dreaming says, what's happening with you, OG? Triple OG, triple. Appreciate you being here, maybe Dreaming, 100%. So let's get right into it, man. We want to talk about today the living benefits of an indexed universal life insurance policy. So just 1011 Trucking says awesome, and he is actually a she. So 1011 Trucking is a she, not a he. Appreciate you being here, 1011. But recently, I did a poll on my page. I sent you some of the results that I got from that poll, Majida.
Yeah.
And the results that I got on there was quite interesting to me. I'm about to pull it up right now, actually, so I can look right at it. But I asked basically how many self-employed truckers, owner-operators, and independent truckers on my page have life insurance. Okay. I got 280 responses, 280 votes, and it's settled at about 53% answered yes, they have life insurance, and 47% of the people that responded to this post say that they do not, as truck drivers, say that they do not have life insurance. And that surprised the heck out of me, because we all know in this profession that trucking is extremely dangerous, right? It's a very dangerous profession. And we all know and have heard the story of truck drivers passing away and not having the proper protections in place, not having the proper things set up in place, and essentially leaving their family in a position to have to struggle if something happens to them unexpectedly. Off topic a little bit, AJ Johnson just passed away recently. Not sure if you guys that are here on YouTube are familiar with AJ Johnson before. You probably are, even if you don't know. But he was an entertainer for years, has a whole laundry list of movies that he's been in. And he passed away recently, unfortunately, unexpectedly. And like a couple days later, his wife was online starting a GoFundMe. Did you know this, Margita?
Mm-mm.
Yeah, you've been busy this week. Yeah. You know who AJ Johnson is?
No, I can't say that.
AJ Johnson is Ezel from Friday. Ezel from Friday. You don't remember? You ain't looking Friday.
If I did, it's been a minute. So
trying to think. AJ Johnson has been in everything, so you definitely know who he is. But yeah, he was Ezel. He was the crackhead in Friday that caught Smokey around back taking a dump. Oh. But anyway, yeah, if you Google him and you bring him up, you'll see exactly who he is. But yeah, he just passed away recently. Like I said, he's got a whole laundry list of movies that he's been in. And a couple of days after he passed away, his wife is online starting to GoFundMe. And not only that, like, she's pissed. I don't know if she still is now, but for a couple of days, she was pissed because she felt not enough people were supporting his GoFundMe. Right. And so just hearing that situation and thinking about that situation, it's like, man, you know what I mean? Like you don't want to leave your family in that situation. Not if you can do something about it. You don't want to leave your family in that situation. Right. So that is kind of, with all of that in mind, with the results of this poll that I put up, polling my audience, and finding out that a big portion of the people that are here don't have life insurance. And then just kind of, you know, every time somebody famous passes away, we hear that story all the time of them not having proper protections in place. And then, you know what I mean, having to do all kinds of weird and crazy stuff, or their family having to do all kinds of weird and crazy stuff after they pass away. And, you know, you got to know that individual, if they had really thought about it and planned for it, they probably wouldn't want to put their family in that situation. So that is what prompted me to want to get my sister-in-law, Majida Bey, on to for her and I to just have a discussion about the benefits of the living benefits of a properly structured indexed universal life policy. I know a lot of people, for a while, I always looked at or thought about the death benefits of a life insurance policy. And I know that, you know, most people are probably familiar with that. You know, you have a life insurance policy, you pass away, the money goes to whoever you choose, your beneficiary, whoever you choose to leave it behind to, and they are able to take care of all of your final expenses, essentially. But there's living benefits. There are benefits that you can get, that a person can tap into while they are still here. And that is essentially what I want to share with you guys that are here that don't have life insurance. If you don't have it, there's a reason. I'm assuming it's probably lack of knowledge, lack of education. And so I got the perfect person on to come on and help educate all of us about how this tool works, and also how the wealthy use life insurance to build their wealth and to protect their wealth. So we're going to talk about all of that right here. Okay. Majida has about an hour. Is that too much, Majida?
No, you're good. I got two though. We started a little early, so I got two. If we need two, I got two.
You got two what?
2 hours.
Oh, I got you. 100%. So yeah, we're gonna get into this, right? If you guys have any questions while we're talking about this, feel free to post them in the chat. I can see your chats, and if there's something that, you know, we can help you with, we'll definitely help you with that. Majid, I also need your the link, if you can send it to me at some time throughout this, to your financial assessment. If I'm right, okay, your financial assessment is what a person would probably want to take, and that will essentially put them in your lead flow, right? Like, that'll give you the ability to see that somebody went through your financial assessment and wants more information, correct?
Yeah, absolutely.
Gotcha. So I'm going to be posting Majita's link to her financial assessment. If anything we're talking about appeals to you and you'd like to go a step further, maybe learn a little bit more, maybe have a conversation with Majita, because she is, I believe she is willing to have a conversation with you guys. That's why I got her here on the channel. But yeah, you're gonna hit her link to her financial assessment, go through her assessment. It's got a few questions for you. And it's gonna basically make it so that she can reach out to you, so she can get in touch with you, and you guys can have a conversation, and you can talk a little bit more in depth about how she can help you in your future. So appreciate you being here, Majita, as always. 100%.
Absolutely, definitely a pleasure. I appreciate the invitation.
100%. Yep. So let's get right into it. Okay. I was gonna write down some notes and all of that good stuff and try to plan out what I was going to talk about. I'm like, I ain't gonna do all that, man. Just going to have a conversation with my sister-in-law about this insurance. You know what I mean? So, all right. So let's start here then. Okay. Why indexed? First of all, what is indexed universal life insurance? What's the simple way to explain that?
I will answer that, but before I answer that, I just want to touch on a couple of things that you said already. Cool. One, 47% from your poll do not have life insurance. And it's not surprising because there are 100 million adults. We say it in our training, irresponsible adults. There are 100 million irresponsible with zero to little or no life insurance. And the reason why
100 million?
Yes, 100 million.
That's a third of the American population.
Right. Yeah. And we're talking about adults. We're not even talking about children. And we can speak about that a little bit later. But the idea that it's education, right? How many of those same individuals have auto insurance? It's all required.
Of them. Yeah.
All of right. It's a requirement. And so if life insurance had the same value and had the same requirement, everybody would have it. But we don't get that education, right? We're not taught the value of life insurance. So because we're not taught that, because we don't get the education, we don't get it, right? And it's just like anything else, you have to have exposure. And if you're not exposed to something, how are you supposed to know what you don't know?
Mm-hmm. Mm-hmm.
So I don't blame individuals for not having it, but when you're educated, when you are informed, then you're responsible to do something about it. All right.
100%.
Now, some people choose not to have it, right? And it's probably just due to a lack of education. So to answer the question, what is indexed universal? Oh, no, one more point on the A.J. Johnson story and his wife's response. GoFundMe is not a plan. And hope is not 100%. A strategy, right?
I'm going to get that on a shirt right there. Hope is not a strategy.
Hope is not a strategy. No. And so I didn't grow up with a silver spoon in my mouth, right? My brother-in-law here has known me my entire life. And so we grew up in humble beginnings, and our parents do the best that they know how to do, right? They make sure you got food in your belly, a roof over your head, clothes on your back. And so a lot of times outside of that.
You muted out. I think you might have lost signal. Yeah, I think you might have lost signal, G. Hope is not a plan, family. I like that one right there. I'm just gonna keep it going while she gets back in. She probably just lost connection for a little bit. Let me flip over to YouTube really quick and see what's going on YouTube. Talking about the living benefits of life insurance today, family. That's what we're talking about. If you're here, I got my sister-in-law on with me, Majita Bay. What's going on, Chris Ward? How you, man? Just saw your comment. I got my sister-in-law here with me, Majita Bay, licensed insurance professional. And what we're discussing here, like I said, she probably lost signal because she is mobile. She's out in her car, so she'll be back in just a few seconds. But what we're talking about here on this live stream, first of all, I've started off with just asking Majita to explain what indexed universal life is, okay? Because I've seen there's a lot of people that are asking that question about indexed universal life policies. I've seen a lot of trucking videos where people are asking questions about indexed universal life policies. So the first question that Majida is answering once she comes back in is that, actually what is an indexed universal life policy? I'm also going to ask her to get into a few of the differences in between like a whole life policy, a term, and an indexed universal life insurance policy. Majida, she's coming back in right now. Majida was just now saying a minute ago that one of the biggest reasons that people don't have life insurance is because of miseducation or because of lack of education. Hey, Majida, you back in now. I actually was essentially, I guess you could say I was miseducated on insurance. Like I had a my concept, my idea towards insurance my whole life up until recently, the last few years, is always get the minimum. That was always my philosophy when it comes to insurance, right? But things have happened in my life right now where I understand. I look at it totally different right now, because I see insurance, generally speaking, as the mechanism that allows me to protect what it is that I'm trying to build. So, I want maximum protection. Okay. And that's the way that I see insurance, generally speaking, right now. So if I'm dealing with car insurance, I deal with car insurance differently now than I did before, just because I see it differently. So, but yeah, Majida is back, and she was, I believe you were explaining to us, you were talking about the AJ Johnson situation and GoFundMe not being a plan. I believe that's where you went out at, where you cut out.
Yeah. So, kind of back to the idea of exposure, right? He likely was never educated, or if he was, he didn't take it. He didn't take heed to that information.
100%.
And so the education went on, because I didn't see insurance that way growing up, right? My understanding of it was that it was a bill, and if things got tight, it was a thing that you let go, right?
You get paid, yeah.
Right. Yeah, you didn't have to pay for that. And so once I was educated, I had somebody who was willing to teach me and help me better understand that it's really the foundation for your financial plan, for any financial plan. Like, it is everyone's foundation. So if you want to be wealthy, it's your foundation. Hey, if you want to live a modest life, it's the foundation. And so just like building a house, you can build your financial house on a solid foundation when you have the right protection in place. Right. So life insurance is part of that protection. Health insurance, disability insurance, car insurance, right? Homeowners insurance. Insurance in general is the foundation for your financial plan. Just like you said, it protects what you're building, because God forbid you lose, right? Something happens to you, or something happens to you in your car, right? It helps to protect your wealth, right? If you're in an automobile accident, you don't want to have to replace what it would cost to afford a Tesla, right? You don't want to have to come out of pocket. And so insurance is simply a transfer of risk, right? It transfers the risk from you to the insurance company.
Love that term. Deductible. I love that term, a transfer of risk. That's very attractive.
You basically pay your deductible. No, you're good. You pay your deductible, and now the insurance company assumes the responsibility or liability of replacing whatever that thing is. And so it's just really changing your mindset about it, right? I joke sometimes that I'd rather be insurance poor, right? Meaning pay a lot of money on a regular basis for insurance than to leave my family financially destitute if something were to happen to me. And so simplest way to think about insurance in general is that you want to, when we're talking about life insurance, you want to protect the goose that lays the golden eggs.
Yep.
All right. Yep. So your income earner in your family depends on your income to support the lifestyle that they have and all of those things. And so we're required to have insurance on the eggs, right? The automobiles, the home, health insurance, right? All of those are requirements, right?
Yep.
We're required to insure the eggs, but we're not required to insure the goose. Nobody cares if you leave your family. Right now, I'm not gonna say nobody cares, but nobody's teaching you to do that. But there are benefits to you, and we can get into the benefits in a little while, but there are benefits to your family when you do have life insurance. Because think about it this way: if you don't protect your family, who's left responsible for them?
They responsible for themselves. You just leaving them to fend for themselves.
right? Or family members or friends or the federal government. So the government says, hey, if there's anybody out there and they need help, right, we have assistance for them. And so, like I said, I don't think that's a strategic plan in terms of your family. And so when you're looking at your family being dependent on your income, if you as a trucker are bringing in 100,000, 150 grand, 200 grand per year, and that income stops, what one thing can you have in place that can replace that at the drop of a hat? And life insurance is one of the only things that can do that. And not just 1 year's salary, right? That's not how much you want to have. In our industry, we say you want to have minimum 10 to 15 times your annual income. So if you make 100 grand, you need to have a million. If you make 200, 2 million. Well, why is that? Well, that gives your family time to transition, right? And then you also want to make sure that you leave instruction, right? So we can get into estate planning and stuff like that later on, but leave instructions so that money will last. Because if people aren't used to having money, or they're used to living paycheck to paycheck and just making ends meet, and you leave them $1 million, a lot of times that money will go just like that,
Yeah.
right? In a matter of months or in a matter of, a short year. And so leave instructions for how that money is to be utilized after you're gone, so that they can stay in their home. They can keep the cars. Your family doesn't have to have an estate sale to take care of their final expenses, take care of, the mortgage, the house, all this kind of stuff. And so it's just what I say the wealthy do. It's anticipating the things that often do and will happen, and simply preparing for them.
Mm-hmm.
And that's how life insurance can be utilized to plan for your financial future.
Yeah.
A lot of times we hear kind of choice words or, cliches about building generational wealth and leaving a legacy. Life insurance is one way to do it, right? That's part of the plan. Like,
Yep.
it's a practical way to leave a legacy and leave generational wealth. And, by signing a few documents, you have now created an estate for your family. You already have one. Like, all of the assets that you own are part of your estate, right? Every single person that's within the sound of my voice, everything that you own is part of your estate. Life insurance can be part of that estate. And if you're leaving 10 to 15 times your annual income to your family, you can create generational wealth at the drop of a hat, right? You go home to the Lord and you pass on. Your family has now become $1 million, $2 million, $3 million, $10 million wealthier. And so how the wealthy use life insurance is, one, they get as much as they can afford. Now, I'm not speaking about all of them, but generally speaking, they get as much as they can afford when they've been educated, when they have a financial advisor, they have a financial professional that helps them strategize and plan for their wealth. They get as much as they can afford, so that when they pass away, a tax-free death benefit. All right, I'm going to say that again. A tax-free death benefit is transferred to their heirs. So can you imagine millions of dollars being transferred to the next generation of your family
Tax-free?
Tax-free.
Nice.
So that's why the name Kennedy and Rockefeller and Ford, right? Because from generation to generation, each generation is getting wealthier. But they don't wait till they're 30, 40, 50, 60 years old to get life insurance. They start when a child is born. At 15 days old, you can get a life insurance policy on a child. So can you imagine if you start a child from age 1, we'll say age 1 or age 0 even, right? At age 0, before they get sick, before they have any health complications, before they mess up their driving record, right? Before they get into any criminal activity or trouble, you get them protected because they're healthy and they don't have any blemishes on their record, anything that would affect their insurability. You get protection on that child. It's able to grow with them over time. And you can always add more over time if you so desire. But did you know that if you got a $250,000 life insurance policy on every 1-year-old in America, you could create a generation of millionaires? And a $250,000 policy for a child costs a few $100s, right? It's not tens of thousands of dollars, right? And 100%. Of course, with the audience that you're speaking to, right? They could afford to do that for every child that they have.
It should be. It should be. I got cats on my channel bragging about they make 10K a week. Every video that I do, that I talk about my pay, I got somebody that come on my video talking about that ain't nothing. Trucker's supposed to make 8,000, 10,000. Trucker's supposed to make 50,000 in a month. That's why I'm surprised why some of y'all don't have insurance. Huh? Yeah. What? Go ahead. I'm sorry. They should be able to afford to do it.
Well, as my coach says all the time, people invest where they see value. They haven't seen the value of it. And I'm sure as we get into the living benefits of it, they'll see more of the value. Most people have seen it as death insurance. I die, somebody else gets a check. And our mindset around that has always been, I'm not leaving, right, a bunch of money to, right, ain't nobody do nothing for me. Ain't nobody leave me nothing, so I'm not leaving anybody anything. We got to change our mindset. If we ever expect to level up, if we ever expect to grow as a community, as a country, we got to shift our mindset. We have to understand that there's a reason why they don't want you to know certain things. They could teach financial literacy and life insurance and 100%. Credit, right? But why don't they?
But they don't. That's such an interesting question. And the answer, it can't be but one answer. They ain't interested in you learning it.
Absolutely. Because what you don't know about money will hurt you.
Costing you 100%. I gotta stop. I want to stop you right there. I want to stop you because you're unpacking a whole lot, right? The first thing that was a nugget and you dropped a lot of nuggets just now, but insurance being a transference of risk. Okay, I made sure I put that in the chat because I want everybody here that doesn't have life insurance, that doesn't have the understanding to understand that right there, right? Like owner operators, self-employed individuals, independent truck drivers. We all take on a lot of risk. That's why that phrase jumped out at me. Transferring the risk to somebody else, I'll take it. I'll take it. Another thing I want to touch on that you spoke about real quick, I would assume, this is an assumption, that a lot of the people that don't have insurance in America, this is just an assumption, one of like certain people don't like to talk about that subject. They don't want to talk about the subject of death. They don't want to deal with the subject of death. And I would assume that there are those that maybe don't have insurance because they don't even want to deal with the subject. And based on what you were saying just now, it seems that the wealthy approach that subject different. Just like you said, like we're all going to face death. It's one of the only things that's guaranteed, death and taxes, right? And so it's like certain people don't want to deal with the subject of what is inevitably going to happen. So what the result from that is going to be. Then you got another group of people that acknowledge that the inevitable is going to happen. They talk about it. They think about it. They consult people about it. And then they put a plan in place to mitigate the effects of when that happens. So for the people out there that have always felt like, well, I don't even like to deal with this subject. That's the reason why I never got into it. Well, the wealthy deal differently. They're not afraid to deal with the subject of what is going to happen and to put a plan in place. Like you're not jinxing yourself by preparing for your death. Like I ain't got no problem saying it like that. Okay. You're not jinxing yourself. I know some people are like, I hate to use the words like that because it is what it is. Damn it. You gonna die your ass off. All of us. Okay. And to not put the protections in place, it's just like thinking that it's like the iguana does. The iguanas, they close their eyes and they think that you can't see them when they close their eyes. You know what I'm saying? So to certain people, they think that when they don't deal with this issue, that it won't come up, when nothing could be further from the truth. You dropped a lot more nuggets as well. They actually slipped my mind. I'm so sorry, but you went into a whole lot. It's
all good. No.
Yeah, you went into a whole lot just now. What is an indexed universal life policy? Can you kind of give me and the audience a simple explanation of that?
Yes. So let me kind of give you a history of life insurance, right? So there's basically two types of life insurance. There's temporary and there's permanent. All right. So let's start there.
Okay.
There's term insurance and there's permanent insurance. All right. So term insurance is temporary, which simply means there's a deadline, 10 years, 20 years, 25, 30 years, then the term ends. Right. It's also what most people have with their employer. It's called group term, right? As long as you're a part of the group, you're covered. You leave the group, you're no longer covered. All right. And so for people who may be thinking that, oh, I got something on my job, Yes, you do until you leave it or until they let you go. And often what they have on your job is not sufficient, right? It may cover 1 year's salary. Depending on the industry that you're in, it could be a lot less than that, right?
Okay.
I have a background in construction, and 25 grand is the amount that is offered to employees. Very dangerous industry to work in. And so that being said, right, what is 25 grand going to do for a family who's used to 40, 50, 60, 80, 100 grand coming in on an annual basis? So that's term insurance, right? Set period of time. It's economical the younger you are. All right. A lot of people think, oh, term insurance is cheaper when you're young and you're healthy and you don't have any blemishes on your record. All right. So insurability is a factor. That's why I spoke about young people getting it or getting it on a young person as soon as possible. They're insurable, right? Before they have any ailments. But right, 70% of our country is overweight or obese. And that impacts your insurability,
Makes
your
sense.
build, right? And so children, unfortunately, are also um, overweight, right, to a large extent. And so that could affect. I've had children decline because of their build. And so they're at their best right out the womb. So 15 days out the womb,
They
get the
on
protection.
they on the decline every day after that, huh? Damn.
Unless you do the right things, you feed them right, right, you give them the right nutrition, make sure that they stay active, right. Unless you're doing that, right, society will right. And this is something not really off topic, it's related. 70% of our country is also on medication.
Some kind of medication. Makes sense.
Right. So if you think about it, 70% are obese or overweight, 70% are on medication. I don't know the exact statistics of how many are diabetic, pre-diabetic, or insulin resistant, but like the numbers are staggering.
Yeah, that's
And
crazy.
the reason why that's important is because and this is something that I've learned from Sean T. He has a show called The Model Health Show, a podcast called The Model Health Show. And he spoke on that. He said, we are the sickest country in the world, and it's self-inflicted. And it impacts your insurability, right? And so you can do something about it, right? So I don't want you to be like, oh, I'm overweight, I can't qualify for it. You can do something about it. I know coaches who are helping people to reverse diabetes, get off of high blood pressure and, metformin and insulin and all of that. Like, I know health coaches who do, but you got to be willing to do the work. And so what it really comes down to is responsibility. We got to be willing to take responsibility for our lives. We can't keep listening to what this might be political, right? We get what the government says or what society says we should do. If we look at the results and we don't like the outcome of the results, we got to do something to change them, right? 70% of our country should not be sick. I know when I was growing up, that wasn't the statistics. And so back to the definition, right? I kind of go off on a tangent there, but back to the definition. So term insurance, usually you can get coverage through your job, right, as part of the group, or you can get it independent of your job. It's economical when you're young. The older you get, the more expensive it gets. And so, for example, if you get a policy at 20 years old, hey, let's say it's $250,000, you're in good health, good driving record, all that stuff. Get a $250,000 policy. Hey, it might cost you 15, 20, $30 a month, right, for a policy at 20, right? But let's say you get that's a 30-year policy. Well, 30 years from now, you're 50, and you've allowed creep to sit in, right? And over those 30 years, you ain't been eating it right. You haven't been eating right. You're not exercising, right? You're doing all of the things that society wants you to do to stay sick. And so at 50, you want to get another 30-year policy. Well, at 50, the expected age for men and women, roughly around, say, 80 years old, right? So you're expected to die by 80. So if you get a policy at 50, you're closer to death. You're more of a risk to an insurance company. At 20, hey, you had another 60 years. But at 50, that $250,000 policy at 50 is not going to be $15, $20, $30 a month. It's going to be a few hundred, if not a few $1,000s a month. So the best time to get insurance is now.
When you're young. Yeah.
Sooner rather than later. Right.
Yeah.
So term insurance, typically more economical. Permanent insurance. There's different types of permanent insurance. And permanent simply means, and I say it this way intentionally, it's designed to last the rest of your life. It should be designed to last the rest of your life. Why did I say that? There are certain things that you have to do it properly so that it does what you want it to do.
Okay.
So term insurance is very clear. 10-year, 20-year, 30-year. As long as you pay your premium, you're covered. You stop paying your premium, the coverage lapses. All right. Permanent insurance, there are different options, right? There's whole life, there's universal life, and under those two, there's there's variable whole life, there's variable universal life, there's index universal life, there's fixed whole life, there's fixed universal life.
Complicated.
Not really, not really. So think of it.
Complicated.
There's permanent, right? I had a little chart there. Term permanent, under permanent, you've got whole life and universal life. Under whole life, you've got fixed and variable. Under universal life, you've got fixed, indexed, and variable.
Okay.
Just to keep it simple. That's the simplest that I keep it right. Like, so those are
okay.
Permanent should be designed to last the rest of your life. There are some people out there who don't promote getting permanent insurance. Now, I don't know them personally, but for those that say that, it's not like a religion. It's not like term is better and permanent's worse, right? They sometimes call permanent policies trash value policies instead of cash value policies, right? So it's not really a religion. It's education, right? And wealthy people have been using permanent insurance for over a century. 1913 in the Internal Revenue Code, it has allowed people to use whole life insurance or permanent insurance to pay money, right? You pay a premium on a monthly basis. That money is able to earn interest. All right. So when we talked about the different types of whole life has variable, which means it fluctuates. So your money is actually invested in the stock market or in mutual fund sub accounts. All right. Okay. So you have to work with a licensed securities agent in order to get a variable policy, whether it's universal or whole, but your money is actually invested in the stock market. So for those who can stomach the risk of fluctuations in the market, your money going up and down, hey, that may be an option for you. I don't tell people what to choose. I give them options, right? Okay. I tell them how it works, right? I educate them about how the different plans work, and they get to choose which one works best for them. So variable means that it's invested in different mutual sub accounts, and it fluctuates with the market, right? So it can go up and down. All right. So if you have a high risk tolerance, you might like something like that. You don't mind the up and down of the market. That is not most people. You're
younger and you're making good money. I would assume, right? You're younger, you're making good money. Like I said, you can stomach the risk, the money that you're putting into it. You don't need it. You know, you're not gonna need it for the next immediate future. Am I kind of right on that? All right.
You don't have to necessarily be young because they're young. I'm a young. I could still consider myself somewhat young. Right?
You're young.
But
you're young.
There's some people who don't like risk, right? They don't like their money. And so it really just depends on your risk tolerance, whether you're young, old, or middle age, whatever the case is. So with variable policies, you want to understand your risk tolerance, right? But that may not be for everybody. So there's fixed. A lot of people, especially older people from like the not the baby boomers, but the generation before them, their parents. A lot of them like fixed products, right? Well, they also like fixed because there was a time when you could get like 16, 18% on CDs, but you were also paying that, interest rate on mortgages. But they like fixed stuff. They like knowing what they're going to earn. Typically with fixed whole life or fixed universal life, it's a level premium, right? With some universal policies, they may call it a basic interest account, to where you earn a set percentage month in and month out, year in and year out, right? So you know exactly what you're going to earn. And then they can show you what the projection is going to be based on earning that amount. Right. So if you have a low risk tolerance, you want to be very conservative, you can get a fixed policy, right? A lot of whole life policies are designed with fixed interest rates. Typically, you're going to earn somewhere between 3 to 5%. They may pay out dividends on a monthly or annual basis or quarterly basis. And so that's one of the benefits of whole life, right? So
Okay.
you have whole, variable, right? Fixed, whole life. And then
Term.
we talked about fixed. Same principle applies. Fixed and variable. Variable with index policies is similar. It's still invested in mutual fund sub accounts. Now, indexed universal life, I'm not gonna say it's new, but it's new to the market, right? I heard about it around 2009, so that's only been what, 12 years. So universal life has been around since like the 70s, right? And the difference between universal and whole life is simply that whole life is level, right? Pretty much everything is level, unless you have a variable whole life policy. But pretty much everything is level, meaning your premium is level, it doesn't change. Your interest is level, it doesn't change, right? Or it changes when the company decides it changes, right? But it's pretty much going to stay the same throughout the duration of the policy. Universal added flexibility to life insurance. So just like our phones have evolved from those big box phones to flip phones to life insurance or financial strategy over time. And so they make new laws and regulations that allow financial companies, insurance companies to do different things with their products. And so Universal Life came around and it added flexibility, meaning you didn't have to just pay a level amount. You could actually pay more into the policy. You could overfund the policy up to certain limits, up to certain maximums. And then over time, that money is able to earn interest based on it being variable or based on it being fixed. And you could control what you contribute. I
And
tell my
that and
clients all
that
the time,
and that trait, what you're discussing right now, is unique to the indexed universal life product.
it's unique to universal life.
Got you. Okay. Got you.
Right. The flexibility,
Got you.
right? So when you think of universal, think flexibility, think adjustable. A lot of times when you
Got you.
see a policy, it'll say adjustable premium, flexible, right? It's telling you that you got options, right?
Got you.
And so where you went from the generic term insurance and whole life insurance, where it was set, everything was set and it didn't change. Universal added flexibility, the ability to adjust and really have more control over the policy.
Got
And
you.
so Index Universal Life came around, like I said, I heard about it around 2009, and it offered the opportunity to earn interest with downside risk and upward swing, right? Or upward, how did I say that? Upside of the market, right? You can participate in the upside of the market with downside protection, and typically you have a cap. So what does that look like? That means that with Universal Life, let's say your monthly contribution, I'm not going to go low for y'all because I don't want y'all thinking I'm just going to put this much in it. Let's say your monthly contribution is $500 a month, right? For y'all truckers, we're going to say 1,000. So let's say your contribution is $1,000 a month. That $1,000 goes into your policy. That's $12,000 a year. So with Universal Life, that means that there's a minimum that you have to put into the policy in order for it to stay in force for what's called the minimum no lapse guarantee period. So for one of the providers that I work with, it's like a 20-year minimum no lapse guarantee or up to age 65. So you have to put a minimum amount. You do not want to design the policy to put the minimum into it. Now, you mentioned earlier, our mindset about life insurance has been to pay the least amount.
100%.
Well, Index Universal Life is designed to put the maximum amount.
I get that.
Because that's how you get the maximum benefit, right?
The maximum living benefit.
Yes. And maximum death benefit,
Got
right?
you.
Because the more you put into it, there's certain we call it a corridor, but essentially what you put into the policy, you have to be able to get out more than you put into it. So if year after year, month after month, you're putting in $1,000 a month, $12,000 a year, over the next 30 years, right? So 12,000 times 30, that's $360,000. Well, that $360,000 is not just sitting there. That $360,000 has worked for you, right?
Beautiful.
It's earning interest using fixed, right, interest rate, or using an index interest rate, which means that when the market goes up, you're able to earn interest up to a cap. When the market goes down, your principal and interest are locked in, and you do not lose your principal and interest. You don't lose any money when the market goes down.
Gotcha.
So that's the difference between indexed and variable. Variable, it fluctuates with the market. Index, it has a floor and it has a cap. The floor could be 0%, which means when the market's down, you don't earn anything, but you don't lose anything either.
Yeah.
Right.
Yeah.
And then the cap is, depending on the company and the product, right? It could be you earn based on the participation. So if the market goes up 20%, maybe you earn 90% of the 20, or maybe the cap is 15%. So it just depends on the company and the product, but there's a cap, right?
Yeah.
So market goes down. If it's down negative 10%, you earn the floor, which is 0. Some companies, they earn a floor of 1% or 0.75. So you could still earn interest in the down market.
Yeah.
And historically, when you compare putting your money in the market, right? So actually putting it in the S&P 500 or in the Dow Jones or in the Hang Seng or in the Euro Stock 50, you put it in any of those and you're actually investing your money year in and year out. Historically, the performance has always been, when it's in an indexed universal life policy, you earn significantly more in interest because you're never losing.
I heard that on the video just yesterday. Yep.
All right. So universal life, index universal life. I explained a little bit about how that is able to earn interest. So you get to choose, right? What are the benefits? All right. There's a minimum. So there's the Internal Revenue Code, the IRS, says that based on the age of the insured, based on the health, all of those things, right? The face amount of the policy. This is the minimum amount that you need to put into the policy. It's going to vary from person to person. Two people could be the same age, but if they have varying health or varying driving records, whatever the case may be, they may have two different minimums. But let's just say for a $250,000 policy for a 35-year-old male, let's say the minimum is we'll say $1,800 per year, right? Let's just say that's the minimum. I mentioned earlier, you benefit the most by contributing the maximum. So what does that look like? If the minimum is $1,800, there's also a maximum that you can contribute. The maximum is something we call a 7-pay premium, which allows you to put up to that amount on an annual basis. They use 7-pay because if you do that approximately for 7 to 10 years, you could potentially overfund the policy enough to where it could pay for itself for
Which
the
means
life
you don't
of the
have
policy.
to put no more money into the policy.
Absolutely. Right.
Gotcha.
And I say could, right? Because all you can control is what you contribute to it. We don't control the market. So if the market's going up, that plan works out well. But let's say, I don't know, the economy crashes for a few years. You may actually want to transfer, and there's options to like transfer into the basic interest so that you're earning more than the minimum, which might be 0. You could earn 2% or 2.5%, whatever that basic interest account is. And then you could transfer it back into what's called the indexed account so that it's able to earn based on that index profile. So flexible, right? You have a maximum, you have a minimum. And typically as a professional, I want to design it to where the person is contributing the maximum that they can contribute, right? I want to make sure it's suitable and affordable so that they can contribute the maximum that they can contribute. All right. So if the maximum that you can do per month is $1,000 and your maximum for the policy is, let's say, $3,000 monthly, then I may design it so that your maximum, according to the policy, is closer to 1,000, because that's going to benefit you the most. You're going to get the most value if you're putting 1,000 and 1,000 is your max, versus you putting 1,000 and 3,000 is your max. Is that making sense?
Yes.
Did I say that clearly? So that's why structuring of permanent policies is so important. You want to work with a financial professional who understands how to structure policies properly so that you benefit the most, not that they benefit the most.
And is it true?
On some toes.
And is it true? No, I didn't want to cut you off. I apologize. But is it true that some agents don't necessarily have the knowledge on how to structure a policy properly for their client? Like, I've heard stories of people hearing this information or some information very similar to what you're talking about, and then going and asking an agent, their agent, like, nah, man, that can't be done, or something to that effect. It's like they don't have in other words, are there agents that don't even have this knowledge?
Yes, okay. Absolutely. Because it takes time to learn. So if you just got your license last month, unless you're a person who, and there are some people who are just very good at researching and understanding stuff.
The rudiments of it,
yeah. But if you're good at taking tests, you can go take the test in the state of Virginia, at least. You don't have to take any prerequisite course. You don't have to prove or have any pre-licensing education. You can literally just go schedule the exam, sit down, take it. And if you pass it, you got a license to sell insurance.
But that don't mean you know what you're doing.
That don't mean that you know what you're doing.
100%.
So it's important to study or get mentorship or get coaching, right, from somebody who's experienced in the industry to help you understand. So that took time for me to get to that point where I could structure them right. You do the best that you can, or you seek advice. Hey, I got this client, they've had this set up, get some insight, get some feedback from somebody who's more experienced before putting somebody in a plan. Because what you do not want to do, and I think this is something that's important, not just in the insurance industry, but in any career industry, you want to do what's right and best for the client. You want it to be a win for you, a win for the client, and a win for the company, right? So the company wins because they get a new client. You win because you get a commission, but you should never put your commission above what's in the best needs of the client.
Yeah, makes sense.
Absolutely. Because if me designing the policy to have $1,000 be the max versus $3,000 be the max, which also means that the minimum is also higher, there's something called a target premium. And typically, like I said, depending on the company, typically the target premium is what the insurance agent their commission is based off of. So if they design it so that the target is higher, they get a higher commission. Even though it may not be what's best for the client.
Got it.
They could design it to where the target is lower, which means they have a lower commission, but the client benefits the most from the policy.
Got it.
So that's something that I learned from a coach. And that just really has to do with your character and integrity, right?
Got it.
So you don't have to go with the first life insurance agent that you sit down with. Interview them and make sure it's a good fit, because it's going to be a long-term relationship. Right? When you pass away, that insurance agent is going to be the one who's going to contact your family, or that your family is going to contact, to make sure that things are handled and that the insurance company releases the payment and all of those things. And so it should be a long-term relationship. I don't see my clients as just clients. Like, I see them as family. The fact that they trust me to help them, their family, with a plan or a strategy, I don't take that lightly. And so, like I said, in any industry, character integrity should be first and foremost in the decisions that you're making, because you're serving people. And if you don't care enough 100%. To serve people well, you're not going to have a very long career. Like, you're going to weed yourself out.
I think that kind of gets into the next question that I was going to ask. I'll still ask it, but before I do want to say this, man. I am disappointed in my audience. I'm dead ass serious about this, family. If y'all watching this on YouTube right now, I'm a little bit disappointed in you guys, okay? I'm looking at my phone right now. We got 11 watchers right now. We're talking about the stock exchange. We're talking about retirement. We're talking about your future. We're talking about making your family instantly wealthier in the event of your untimely demise. We're talking about your future. We're talking about retirement. We're talking about, you know what I mean? We're talking about money. That's what we're talking about. We're talking about protecting your assets. And we got 11 people watching right now. You know what I'm saying? Like, it's a little bit crazy. I'm thankful for you guys that are here, because I'm not going to sit here and complain about who's not here because they ain't here. But it's like, that's a little bit ridiculous, man. If there's a lot of us out there as owner operators and independents that don't understand this life insurance stuff, are not saving for our future, don't have an adequate retirement plan in place, don't have a plan in place to keep us out of the GoFundMe, to keep our family, our wives, our husbands, our loved ones out of the GoFundMe if something happens. Like, I mean, I can come on here right now and title this video how to make $50,000 the next month. And I guarantee you all 30,000 of my subscribers will be on, plus a few that ain't my subscribers. A lot of these people in trucking, all you guys want to hear about is the money. That's all y'all want to hear about is how to make the money. And while that's important, it's not the only thing. Like, it's not the only thing. There are a lot of high paid professionals, a lot of high paid people in trucking that are still living paycheck to paycheck, that still have not figured out how to do a budget, that still are not properly preparing for their future. There are people like the AJ Johnson that I mentioned earlier that are this dude has made money his whole life and did not have protection for himself and for his family. He's got his wife. I don't want to say he's got, because I don't want to sound insensitive, but his wife is upset because more people aren't supporting their GoFundMe. That's not a conversation I want my wife or my loved ones to have with anybody in the event that something happens to me. So again, I'm gonna be honest with you, man. You know, I'm actually, for the most part, I like to say I'm proud of the audience that I've attracted here on YouTube. I don't have children on my channel. I don't have immaturity on my channel. I don't have a lot of cursing and N-word this and all of that crazy foolishness on my channel. I'm thinking on my channel, I got 30,000 professionals, you know what I mean? Men and women. Like, I'm reading messages from people that are airline pilots and people that are you know, sales managers and all of these big titles that I'm hearing from, you know, in my comments and in my email. And it's like in my opinion, I'm like, man, I got a pretty mature audience here on my channel. You know what I mean? And I'm not saying that you guys aren't mature. I love you guys that are here, but 10 to 15 to 13 people watching, and we're talking about money. We're talking about real money. Okay. We're talking about what to do with your money after you make it. Like, I would think that a subject like this would be, I mean, I was going to start this off by saying this is one of the most important, boring conversations that you're probably going to have. To me, it's not boring though. To me, it ain't, but I'm saying that because that's the way other people perceive it. But to me, when you're talking about how to protect, like, I'm busting my ass out here right now every day. All of us are. And the last thing I want to do is just make money and then just come home. Like, I want to put some safeguards in place so that I can get out of the position that I'm in. Not that I'm in a bad position, but like, I want to move forward and never look back. I want to keep moving forward and never look back. You know what I'm saying? And like, the same thinking that got me to that point is probably not going to get me out of that point. This is a subject right here that if you don't have it, if you're not doing this, even if you are doing this, this is the subject. This is the conversation that owner operators, that independents, that self-employed truck drivers need to be having. Not just what company to go with straight out of school, or who can I go with that's going to pay me $5 a mile. Like, what are some safeguards I can put in place to ensure that as I'm making this money, me and my family never have to go back? So I got to admit, I'm a little bit disappointed in that, but hey, it's all good. We got some here, and I appreciate you being here, Majid. I would have liked to have gotten you a bigger audience. So, but my next question is, I want to move on for that because I ain't gonna spend much time on that. It's all good. I'm gonna focus on what's here and what is present. And you may have already answered this, and I am looking at time as well. Why do you think indexed universal life policies get a bad rap? Because there are people that some people don't like. Dave Ramsey, for instance. Dave Ramsey, and I mean, I've heard his perspective on index universal life policies, but that's the reason why I like to throw that adjective in there, a properly structured index universal life policy, because a lot of times when I hear people talking about the downsides of it, I don't hear those words, a properly structured or properly funded index universal life policy. So in your opinion, have you heard a few people that have given this product a bad rap? And in your opinion, why does it get a bad rap from some people?
I really think, like I said, it comes down to education. You know, people like to be, I was going to say bipolar, but they like to have, you know, they like to be on a side, right? So it's like either you're for it or you're against it. And as a professional, I do what's in the best interest of my client. I may not recommend an index universal life policy to a client who can't properly fund it. I might offer them term and show them how to build their emergency fund, then show them how to eliminate debt so that they have more money to then fund a permanent policy, right? But like you mentioned earlier, death is guaranteed, right? Like that's going to happen. And so I could get them a term policy in their 20s, in their 30s, and they live for the next 30 years. That policy runs out. Then what? Hopefully, right? Like, and I said, hope is not a strategy. Hopefully, they've built wealth over those 30 years outside, right? Like they had the life insurance, which is the foundation for that protection. 30 years from now, hopefully they're wealthier. But the question is, what if they're not? What if they did the bare minimum, right? They did, they were living paycheck to paycheck over those 30 years, but they got something. And then 30 years from now, they no longer have a policy. Year 31, they pass away. Then what happens to their family? Then what happens to their legacy? Right. So that's why I'm a proponent of at some point getting permanent life insurance, right? Even if you can't get it right away, over time, you should be growing towards getting something permanent. All right. The first policy I got, it was a permanent policy, but it was after I got some education. And over time, I've gotten more policies, right? You can get as many policies as you can afford. So when you think about, let's say, like an IRA, there are limits to how much you can contribute to an IRA. With life insurance, if you can afford it, you can buy as much as you can.
Get into that. Continue that thought, but get into that, because that was going to be one of the questions I was going to ask as well. Can you maybe share with us a few of the differences between insurance as a product to protect our wealth and grow our wealth, as opposed to like a 401k or an IRA? So if you continue with what you were saying, but I kind of flow into that as well.
Absolutely. So with an IRA, 401k, all of those are qualified plans, right? Which essentially mean you contribute to those policies, right? Those plans before they're taxed. They're able to grow tax deferred. And when you're ready to access the money, you pay taxes on it.
So you don't pay taxes on the seed. That's essentially what you're saying. You don't pay taxes on the seed, you pay taxes on the harvest.
Absolutely. All right. And so sometimes when I ask that question, people are like, I'd rather pay it on the harvest. No, you won't.
No, I'd rather pay it on the seed. Get that out the way.
Seeds or apple orchid, right? Which is more? So if you have more, you're going to have to pay taxes on more. And I've been seeing some things lately about, tax policies and things like Biden's policy changing. And so can you imagine you grow a harvest and then you have to give 40%, 50%, 60% to Uncle Sam?
Yeah.
I don't know about you, but I'm just not comfortable with working, and putting all my money into something for my family. And then Uncle Sam says, no, I need to get my cut off first. Right.
Yeah, that's what the pimps do. Go get my money though. I need mine off the top.
And so in addition to that, there are limits to what you can contribute. I got a letter a couple of years ago at my job stating that I was a high income earner or something. And so like I could only contribute but so much to a 401k. Like I don't know about anybody else. I don't like being told what to do. I don't like being limited by what I can do. And I have never, in any of the policies that I've never been told that I couldn't put more into my policy.
And you're talking about in any of the policies that you have, you're talking about the universal life
insurance.
Yeah.
Yes.
Yeah.
None of my policies, right? I started off with my first policy putting $150 a month into the policy. The minimum was $110. The maximum was about $500 a month. And like over time, I was putting in $300, then $400. Like I just contributed more to it over time as I could, to get the most value out of it. But nobody ever said, oh, you can only put that much, right? So as much as I could afford, and later on, as my life changed, I got more protection, right? Yeah. I got one policy when I was single, no children, only had a mortgage, a little bit of debt. Well, I had a child, I got more protection. I got another house, I got more protection, right? So I'm protecting the wealth as I'm building it. As I acquire more assets, I need more protection.
Is it time for me to do that, or have we already done that? Like I just bought the truck and all of that stuff a few months ago. Is it time to reevaluate that stuff again?
It's probably, yeah, right. Because I think just last year we got you some additional protection right?
I don't know. My wife is you and Yasmin handling that, but I believe so. Yeah.
Yeah, it was like earlier this year. We got you some more protection, but yeah, since you started your business, it'd be a great time to reevaluate. Right, you have some assets, your truck, right? Like so, 10 to 15 times is kind of like the standard, right? But we also have a method we right, DIME. D is for debt, so have enough protection to cover your debt. I is for income. We say 10 times your income. All right, so let's say you have $50,000 in debt. Your income is 50 grand a year. 50,000 times 10, that's $500,000. So $500,000 plus 50,000, that gives you 550. You have a mortgage. Well, the average mortgage maybe is probably more now, but we'll say $250,000, right? So let's say the average mortgage is $250,000. That's 250 plus 550. Then you got 800,000. And then let's say you have 2 children that you want to send off to college, if you're here or not. And the average college cost, they're probably also going up. Let's say it's $100,000 for 4 years. So 2 children, that's 200,000. So that's $1 million in protection based on covering all of those things. If you just cover the income, have half that, right? So it's better than nothing. But if you could cover all of those things, and it gives you peace of mind. I don't know about anybody else, but it gave me peace of mind knowing that if something happened to me, my family wasn't going to have, scramble or figure things out. They could literally have some peace of mind, call my coach, call my mentor, my financial advisor, and say, what do we need to do? And he could be like, I'll take care of it.
Yeah.
Like they don't have to worry. They don't have to start a GoFundMe. All right. Yeah. And I ain't been in any movies that I know of. And exactly. So you don't have to be wealthy to do it. I started with what I had where I was, right? $150 a month. And then over time I increased it, but it's cumulatively what I pay for insurance on a monthly basis is greater than any single bill that I pay, including my mortgage.
I got you.
So it's value, right? Protecting my family is a value. So I'm willing to invest as much as possible into it.
Yep, makes sense.
All right. So when you were talking about what you can contribute to a policy, right? There's no limits. I make more money.
Whereas with the IRAs and 401ks, there is a limit.
There's a limit, yeah, based on how much money you earn, and all based on your age. Mm-hmm. So limits to that. Yeah. Another benefit to using life insurance is, like I said, flexibility. Universal is flexibility. So unlike your 401k, unlike your IRA, whether it's a Roth or traditional, because with Roth, yes, you don't have to pay taxes on the back end, but you still have to wait till age 59 and a half before you can access the money.
And you still got limits on contributions. Your contributions are still based on income and all of that good stuff, correct? Yeah.
Yeah. Yes, you're limited on contributions and you're limited on when you can access the money.
Exactly.
Now, there are stipulations that allow you to access it sooner if you're getting a mortgage, or you can get a loan and pay the loan back. And I've seen people do that as well. But it doesn't come with life insurance. So imagine being able to do exactly what you do in your 401k. If you're going to take money out to invest in real estate, or you're going to take money out to start a business, or you're going to take money out to send children to college, let's do that with your life insurance, but you still have life insurance in addition to that. But the difference is with the 401k, with the IRA, you typically have to wait till 59 and a half to avoid being penalized.
Mm-hmm, mm-hmm.
I don't have to do that with my life insurance. Yeah. I've had my oldest policy for now 12 years. And I'm 36 years old now, so I've had it since I was 24. I've used my policy like a bank. That's the easiest way to put it.
So the word that you haven't mentioned this word yet, but I want to point this out. Now you're talking about the benefits in the IUL compared with other investment vehicles, and you're talking about your money that you put into it being accessible. I know that's probably another big thing that people have. Like when I put money up somewhere, I want to be able to access it. And obviously with these other financial products we're talking about, with typical IRAs, 401ks, your money's not quite as accessible as with a universal life policy. Is that essentially what you're saying?
That's accurate. That's accurate. All right. So understanding too how plans are structured. Right? So I said my oldest policy I've had for 12 years, and I've probably accessed it. I feel like I'm saying that wrong. Accessed it maybe more times than I need to, but I still have the $300,000 in coverage that I purchased. I've been assets, right? I took money out back in 2014 to use
Break
as a
that
down
down.
payment.
Break that down for us, if you would. How did you talked about how you're funding it and how you can go back and overfund it, right?
Yeah.
Talk a little bit more in depth about how you accessed the money early without penalty. And if you don't mind, also talk about, okay, I accessed my money, but you said something a minute ago. You said my money is still there. I think I heard you say that a minute ago. So your money is still there, but you access the money. Is that what I heard you say? Something to that effect?
So let me clarify.
Okay.
So I was saying that I still have the protection, right? I bought up $300,000 worth of coverage.
Mm-hmm.
And so when I put money into it, that money is able to earn interest based on, I'm using a global index based on how the global index performs. In that particular policy, like 13.25%, I have a floor of 1%. And so market goes up, I make money.
Which means if the market goes up, you cap out at 13.25 on the top end.
Yeah.
But if the market is down, you're still earning 1%.
Absolutely.
Love it.
All right.
You're not losing money.
You're not losing money, right?
I love it.
So the minimum in that particular policy was 110 when I purchased it. I started off contributing 150, right? So I didn't start at the minimum, but 150 was all I could squeeze out at that time, right? Till I paid some things off, freed up some more money so I could contribute more. And so over time, I contributed more to the policy. So within 2 to 3 years of me contributing that 150 and then over time increasing it, I was able to actually take a few $1,000s out of the policy to renovate a house that I own in Norfolk, Virginia, so that I could rent it out. I still have the $300,000 in coverage, right? The only reduction in that death benefit is the money that I took out, right? So instead of 300,000, I might have 298,000 because I took out a couple grand, right? So there's different ways that you can access the money. You can take it out as a withdrawal, or you can take it out as a loan.
Now explain that. Now, just now you were explaining the withdrawal, correct?
Right.
Gotcha.
Right. So you can take it out as a withdrawal. Essentially, anything that you put into the policy, you can withdraw, no harm, no foul. All right. It's the money that you put in. So with life insurance, it's first in, first out, right? What you put in first is the money that you take out first. The interest that your money makes, or the money that your money makes, is the last in to the policy, right? And so when you start to access the interest that your money earned, you want to take it out as a loan. Why? Loans are not considered income. And so the interest that you're, right? So if it was in any other vehicle, 401k, IRA, CD, mutual fund, that interest that you earn, Uncle Sam wants a piece of it, right? 100%. You got to declare it on your taxes, all that stuff, right? So Uncle Sam wants a piece of it. Well, in life insurance, if you earn interest, right, or when you earn interest on the money that you put into the policy, and then over time you start to take that money out, vacation, investments, whatever the case is, when you start to take out more than you put in, so let's say over time you put in 50 grand, that 50 grand has grown to 150. If you want to access that $100,000 that your money made, you want to access that as a loan to legally avoid paying taxes.
Shout out, Myth Leather for the $5 super chat. I appreciate the love. Continue on with this right here. This is the subject I love right here. Like, keep going, please.
So the money that your money makes, you want to take it out as a loan, because loans are not considered taxable income. So that's legally how you can avoid paying taxes on the interest inside of a life insurance policy.
So hold on, let me make sure I'm with you, and make sure that me and the audience are with you. Hypothetically, using your numbers, hypothetically,
yeah,
you know, I got a minimum of 110. That's my premium.
Yes.
I'm funding my policy with 150 a month. I'm gonna do that for a few years. After a few years, I've accumulated some money that I can access inside of my policy. I'm gonna borrow against that money. Is that
you
what you're
can
saying?
borrow it?
Or
you can
withdraw
borrow
it,
or withdraw it, right? It's up to you. Typically, you can borrow more than you can withdraw at any given time. Every policy has what's called a surrender period. Okay. All right. And so it could be 10 years, 15 years, 20 years. All right. And so essentially, the money that you have access to is graded based on that surrender period. So if I put 10 grand in this year, I don't have access to 10 grand because it's a long-term strategy,
Makes
right?
sense.
So I know I've talked about accessing the money and stuff like that, but it's a long-term strategy. It's intended for you to think long-term, right? 15, 20, 30, 50 years down the road. However, it gives you the flexibility to access it now, right?
Tax-free.
So I tax-free. All right. And so I design policies so that the client is getting the maximum benefit. However, if they want to access money to invest in assets, right? Income producing assets.
Or to remodel a rental house.
Or to do that, or to put a down payment on a new, whatever they want to do with it, they can access it without any penalty.
That's crazy.
It's
with no penalty
money.
and with no paying and without paying taxes.
Absolutely.
That's crazy. I hate to keep jumping in with you, but that's bananas. That's crazy. Like, I'm saving money. I'm buying a product. I'm saving money and paying for this product. I can access the money that I'm putting into this product tax-free, penalty-free. I still have the product, and then I can use the money to go and make more money. Like, that's freaking crazy. That's crazy. That's crazy. Like, I'm dead serious. Like, it's crazy. That's crazy.
And I wouldn't be able to speak about this what's the word? Candidly, or so with such conviction if I didn't do it, right? Policy for 12 years. And I promise you, I've bought 3 houses over that time period. And the 3rd house, I took money out to use as a down payment. So like I said, I've been using it as a bank, but I still have the $300,000 policy that I bought 12 years ago.
And this is another subject that, like, maybe, like, I'm looking at the time, like, maybe I can get you back on to talk about this, because, like, the subject of being your own bank, that's a whole video I would say in itself. Like, I've watched several videos online about people that are expounding on that concept of being your own bank. It's appealing to me because I don't like dealing with the bank. As far as I'm concerned, man, the bank are jerks, man, for real. Like, you can have money in the bank and the bank is loaning your money out to other people, but they won't loan it to you. You know what I mean? Like, it's crazy, man. Like, the bank, like a lot of these banks nowadays, it's like the only thing that you're doing for us as account holders is holding our money. Like, that's all that you're doing, right? And in some cases, if we ain't got enough money in that account, you're taking a part of that as the bank. So, like, I have a like if I'm smiling when I walk in the bank, I'm putting my game face on. It's like these people are not on my team. That's the way I feel about my own bank, and it shouldn't be that way. So hearing about this concept of operating as your own bank has been appealing to me. I've spoken about this in my videos before. Like, you can do this and operate as your own bank. And when you can do this, like, you still need your credit to be good and all of that good stuff. But like, I don't like jumping through hoops, man. And if I can operate as my own bank, it's like, I don't need to pay attention to my credit score. I need to pay attention to my credit score. But the point is, if I can operate as my own bank, then I don't have to worry about jumping through that hoop. I also don't have to worry about all of the qualifying and all of the stuff that the bank gonna have you doing and all of this stuff. It's like, man, forget that. I'm writing a check for it. And the money that I'm tapping into, that's gonna allow me to write a check for this thing, the product that I've invested in, I still have it. In some cases, the money that I invested in the policy is still there, growing with the market. And I've just borrowed against the money that I've invested in this policy. And I've taken the money that I borrowed and went to make more money. If somebody told me this is the secrets of the wealthy, I would believe it, because that is not something that my parents have taught me about, that regular people is talking about. We're just not talking about stuff like that. 100%.
And so let me make a quick distinction too. And like I said, the financial industry is constantly evolving. Products are constantly coming out and changing, stuff like that. So something is, like I said, is always better than nothing. You want to have some type of protection. But the main difference when insurance, the main difference between whole life and universal, and I can't speak for all companies, but I know with a lot of companies that I work for or work with, the loan rate, right? When you access your money via a loan, right? With whole life policies, traditionally, you're paying 6 to 8% on the loan. So imagine this, you're paying your premium every month, and then you want to access your money. You have the right to do that because it's a permanent policy. By the Internal Revenue Code, you're allowed to do that. However, with whole life policies, if you're earning 3 to 5% in that fixed interest, and you're being charged 6 to 8% on the loan, now you can see why people may view them as trash value policies.
Yeah, that's backwards.
Because
it sound like
it is. But that unfortunately is the case with some traditional whole life policies. Like I said, things are constantly evolving. So I don't want to say blanketly all whole life policies charge a higher loan rate than the interest that you earn. However, I know with policies that I have and with ones that I offer to my clients, the interest, the loan rate when you take money out on a universal policy or index universal policy, I know with one of my policies, the current rate is 0.75%. The guaranteed rate is 1%.
so you want to pay you want to pay a loan back at the bank's interest rate, or you want to pay a loan back at 0.75% interest? It's crazy. That's crazy. Go ahead.
And let me qualify that. There's two different ways, right? So the current rate on the cash that you put into the policy is 0.7. The gain rate is actually, after 10 years, is 0%. So you could essentially have a net loan rate of 0%. And the way that it works is that if you take out 10 grand, right, and you're charged 2.75%, for example, on that 10 grand, but that 10 grand is also being credited 2%. So that's where you get the net loan rate of 0.75%, right? So I'm paying net 0.75 on that loan. However, on a gain basis, access the interest that my money made, I take out, right, 50 grand from the interest that my money earned. The current rate is 2.2%, and I'm charged 2%, and I'm credited 2%. So that's where you get the net loan rate of 0%. So essentially you could have a net zero loan rate. And that's how people use life insurance to supplement retirement down the road, right? Let's say you never touch the money, you just 40, 50 years from now, you're like, all right, I've contributed over this time period. I want to start to now access the money and use it as an income. You can now start to access that money tax-free. Tax-free. You can access the money at any time, right? There's no limits to what you take out. You still have the life insurance policy, right? So yeah, it's flexible, right? You own it, you control it, right? So difference between owning versus renting, right? You own a home, you can do what you want with it. You renting a home, there's some stipulations, some guidelines you got to follow. And so that's the difference between really the term versus permanent insurance. You want more control, you want to have more permanent policies.
Yeah, good stuff. Do me a favor. I want you to take just a few seconds. You might have to go through your phone and grab the link to your financial assessment. Grab the link to your financial. You already put it in?
I put it in the chat with us. Yeah.
Okay. All right. Let me go and put that in real quick. Hang on 1 second, YouTube family. Let me grab this real quick, because I want to make sure that those of you that are interested have a way to do this. All right. Let me see here. Hang on 1 second. Okay. How you close this chat down in here, man? Close. All right. Boom. There we go. All right. Put this in here real quick. Paste. Let me put one more thing in here with it. I type with one finger, family, so just bear with me. Assessment. All right. Boom. I need to pin this comment as well. Pin message. All right, boom. All right, so I got the link to Majita's financial assessment pinned in the comments of this video. Okay. And I'm going to make sure I pin it on the replay as well. Those of you that want to know more or would like to actually have a conversation with Majida, because as she's letting us know right now, this is something that the agent, whoever you're going to deal with on this, it's a personal thing. Like, it's not a blanket way to set it up. You're going to have to, assess where you are, where you want to go, your time limit, your risk tolerance, and all of that good stuff. So that's what the conversation is about. You know what I mean? And if you want to go more and learn more about some things that you can do, make sure you take Majida's financial assessment. And I believe at the end, they just got to click submit. And then that's going to forward their information over to you. And that's going to give you their information, and you can reach out to them at some point, correct?
Yep.
I'm encouraging you guys to reach out. Those of you that need it, that don't have it, I'm encouraging you to reach out. Majida Bay is my sister-in-law. I trust her. Okay. And so that's why she's here. That's why I'm totally cool with sharing her with you guys, with my audience. Okay. Got a couple of comments here, and then I'm gonna ask you to share just one or two more things, and we're gonna wrap this up. I know you got your little ones you got to get ready to get back to. I'm gonna read just a couple of comments that are here. Myth Leather CO says, I'm not even a trucker, but I enjoy your content. Appreciate that, Myth Leather. Gamer Dad watching from Brazil. Shout out to Brazil. Used to live back in Florida, have family back in the States. Your vids are great. Good advice. 100% Gamer Dad. Appreciate you being here. Myth Leather, one more time. I appreciate the super chat. Thank you for the support. Myth Leather says, great topic. You too. Dayton Womack, we appreciate this, bro. Thank you, Dayton. I appreciate you being here. Roylanda Cummings, penalties are serious, and I believe she's talking about the penalties for accessing your money inside of 401ks and IRAs. Yep. L Simpson says gems. I totally agree. These have been gems that have been dropped during this video right here. Kenneth Jackson says, thank you for this information. Checking in from Atlanta. Appreciate you being here, Kenneth Jackson. Are there any more you shared with us the benefits of the universal life policy, as far as it's indexed, which means it helps you to avoid risk, right? There's a floor and there's a ceiling. Okay, so you've kind of explained to us the indexed portion of Index Universal Life. You've explained to us the universal portion as far as the flexibility. You've explained to us some of the living benefits of an IUL, how there are, if set up properly, how there are no contribution limits, the flexibility, and how you can access your money as well, tax-free. And what you choose to do with that money is up to you. If you're smart, you'll take that money and go make more money with it. Go for it.
Yeah. Go for it. A couple of things. So there are limits set by the IRS based on the face amount of the policy. But once you cap out at that policy, you can go get another policy.
Got you.
So
there's ways around that.
Right. Yeah. So that's the only thing that limits you is the face amount, or you can increase the face amount of your existing policy. So it's flexible, right? So the premium's flexible, the interest is flexible, the face amount is flexible, like everything. You control it, you own it, you control it. So you can make the adjustments to make it work better for you. 100%. Right. And likewise, if you need to downsize, you can reduce the face amount, you can reduce the contribution, right? So it can fluctuate. I've had to fluctuate over time, just based on different life changes. But I still have the policy. I'm still fully protected no matter what happens. So, like I said, with the term policy, you miss one premium payment, your policy can lapse. With the universal, right? I've had periods of time where I might be going through things, financially, right? Because I don't want to sit here and act like I got it all figured out. I'm still human, right? So I may go through some challenges financially or go through different transitions in life, and I'll stop making contributions to my policy or policies for a period of time, and then I'll resume and pick back up making contributions. Because I've been overfunding for the most part over the course of the policy, I have that flexibility. So when I said that I started off paying $110 a month and then paying $150 a month and then increased it to $300. Well, $110 is the minimum. I'm doing $300. I'm doing significantly more than the minimum requirement. So the more that I'm putting into the policy, that's more that's able to work for me. which is why I was able to access it within 2 to 3 years, right? So I don't want
Makes
people
sense.
thinking like, oh, I'm just gonna put the minimum in and then I want to touch the money in 2 years. No, it's probably going to take you 3 to 5, if not longer, if you're doing just the minimum. When you're overfunding the policy, that's what allows you to have access to it sooner rather than later.
Makes total sense.
Right. And there's also other ways, and I don't want to get too much into this because this is a different level of it. You can actually use your life insurance policy as collateral to where, right, because you have that, you can borrow money at a different level, right? So just something to consider, right? It's a tool. So some of the other living benefits, right? We just talked about like accessing the money, the interest that you earned, and the tax benefits. There are also living benefits in terms of if you get too sick. So there's 3 scenarios in life, right? If you die too soon, if you live too long, and if you get too sick. All right. So if you die too soon, you have the proper protection in place, right? That's the life insurance. If you live too long, you have money that's able to earn and grow and work for you over time that could potentially supplement retirement or help you invest in other income producing assets or whatever you choose to do. The third option, though, is if you get too sick. Unfortunately, medical expenses is one of the leading causes of bankruptcy in our country, right? I said earlier, 70% of our country is overweight or obese, 70% are on medication.
Unhealthy.
Right.
Basically
and so
yeah.
Because of that, we need to protect against getting too sick. Most people think, okay, if I get sick, the government's going to take care of me, right, through Medicaid. Well, to qualify for Medicaid, you have to be poor, right? Essentially, you have to have no money.
Mm-hmm.
And to qualify for Medicare, you have to be my father's age, right? He just turned 65 this year, and now he can qualify for Medicare, right? Care, think of it this way: care, Medicare for the elderly, Medicaid aid for the poor. All right. So if you're not poor and you're not elderly, what do you have to protect you when you get too sick? You either have to sell off all your assets.
You got nothing. Yeah, asset. Yeah. Okay.
If you have to sell off all your assets, or when you're educated, you could use, right? So, like I said, life insurance has been evolving. There are life insurance policies, and I know particularly universal policies, in particular index universal policies, that also offer living benefits that are chronic illness, critical illness, or terminal illness. Now, most life insurance policies, term, permanent, whole, index, universal, all offer terminal illness, which means that if you're diagnosed with a terminal illness, the doctor says you have 12 to 24 months to live or less, you could actually access up to 100% of the death benefit. So if you have a $250,000 policy, you could actually get that $250,000 before you pass away because of the terminal illness rider, right? It's called a rider on the policy. So that's almost standard with most policies today. Chronic illness is when you can't perform 2 of the 6 daily activities of living, right? It's also what we consider long-term care, all right? So there's standalone long-term care, but there's also the option of having long-term care as a rider on a life insurance policy, which essentially allows you to access up to a percentage of the death benefit amount while you're still living to take care of medical expenses, right? So if you're out of work, you can still pay your mortgage. You can still pay for your bills. You can still put food on the table, right? If you're diagnosed with a chronic illness, or you need long-term care. So critical illness is if you have heart attack, cancer, stroke, ALS, renal failure, paralysis, right? Depending on the company, they offer different benefits and features. So they may have fewer or more critical illnesses that qualify. But essentially, let's say you have a heart attack, right? 70% of our country is sick. So the chances or likelihood of people having a heart attack, cancer, stroke, all of those things are high.
Yeah.
Right. So imagine having a policy that you qualified for before you got sick, being able to access, right, not just the cash in the policy, but up to the face amount. So if you haven't built up the cash that's equal to or in excess of the face amount, you can actually access up to the face amount to take care of medical expenses, take care of doctor bills, all right, until you're able to get back on your feet and then get back to work. Now, in those cases, yes, the policy could terminate when you access those benefits, the critical or chronic or terminal illness, right? Like you're using the benefits before you pass away. But it can also still protect your wealth. Medical expenses are one of the leading causes of bankruptcy. So if you have something in place now, you know you're going to pass away. So now your life insurance is not just a life insurance policy. It now doubles as a long-term care policy, if you will, right? It doubles now as right, because your health insurance doesn't cover chronic and critical illness. Medicare only offers 100 days of skilled nursing care. So even as an elderly person, you got 100 days of skilled nursing care. After those 100 days, you then have to qualify for Medicaid. And if you don't qualify for Medicaid, you have to sell all your assets to be able to qualify for Medicaid.
I've heard people talk about that before. That's so messed up sounding.
Right. So essentially what we are trying to, or what we're educating our family, our audience here about is anticipating the things that can and often do happen in life and prepare for them. You be in the driver's seat, right? Like just like you're the truck driver, you got to be in the driver's seat of your life. Don't leave things to chance that you can put in place and do to protect yourself, protect your family, and protect your wealth. You're not going to leave generational wealth. You will not properly plan for it. It's not going to happen by chance. Just because you made a lot of money and stuff a lot of money in the bank, you leave a lot of money in the bank when you pass away, I promise you, Uncle Sam will end up with most of it.
100%.
Your estate will be taxed. Insurance is one of the only things that can avoid probate because it already has a designated beneficiary. That death benefit goes to that beneficiary tax-free in most cases, right? There are some stipulations, right? But in most cases, it goes to the beneficiary tax-free. You don't have to deal with that process. You don't have to deal with people fighting over the assets that you left behind. And so that's why when you talk about, I mentioned earlier, in the estate plan, leave instructions. Don't go through all of the work to get a life insurance policy and do all of those things, and then that death benefit goes to the beneficiary, which is great. But then you have your assets, you have your trucks, you have maybe some rental property that you've accumulated, and you haven't left instructions for all of that stuff. Protect that stuff as well through an estate plan, right? Sit down with an attorney and figure out how you need to structure those things and who you need to designate as a trustee because if you don't do it, the government will do it for you. There are laws in place to tell you what to do with your assets after you're gone if you don't leave instructions or leave a plan in place. So
100%.
Just wanted to add that a little bit.
I appreciate you adding that. Is it possible to get you back on here?
Absolutely. Anytime.
100%. Well, I know you're a busy person, but I'm totally interested in having you come back. You know what I mean? Maybe we can discuss this subject again, or maybe the next subject. You know what I mean? Like maybe some popularly asked questions dealing with this. I would like to talk about using this to help you be your own bank. I definitely would like to share your perspective with my audience on that, right? So this is the business, family. This is the business. This is what it is, right? This is what it is. This is, in my opinion, what all of us need to be talking more about, not just the top line, not just how much money you make or how much money you gross or what you did last week or last quarter. All that's good and fine, but like we need to be talking about how to really take things to the next level, how to protect what I'm trying to build, tax-free retirement, tax-free transference of wealth to my children. I'm out here busting my butt. I ain't doing all of this to just, you know what I mean? Just let a third party step in and direct all of this stuff. Yeah. So these are important conversations that we're having right here. We're going to come back and discuss this again at a later date. Majida, I most certainly appreciate you for taking time and sharing all of this stuff with me and my audience. Is there anything you wanna end up with? I mean, you gave you gave everything. Is there anything you want to summarize with?
10 years of experience and knowledge that I've accumulated. So, hopefully in the last hour and a half, we've added some value to your audience, and we've planted some seeds, right? Let it kind of wash over you, think about it, sit down. Maybe if you took some notes, go back to those notes, definitely reach out. And you can actually schedule a complimentary consultation
My
Oh,
notes.
you got some notes there.
I'm right. I
Right,
hope y'all watching here on YouTube took notes. Seriously. Go ahead,
yeah.
Margita.
But yesterday, September 30th, ended Life Insurance Awareness Month, and so it's just perfect timing in terms of having this conversation. It's a time children are back to school. People are a lot more. I mean, people may have been active during the summer and stuff like that, but like everybody's now active and constantly, going on. So don't just let life happen, and don't leave things undone. All right, that's the easy way. It may take some time to get things through, but I promise you, it doesn't take as much time as you think to be able to sit down, have a conversation, put these things in place. And once it's done, right? You can make modifications and adjustments to it over time, and you can increase your coverage. But once you go through the process the first time, you realize that it's not as difficult as it has to be, and get comfortable having the conversation, right? Like, it's something that we all have to deal with. And one of my favorite speakers talks about it's life activities, right? Preparing for death is a life activity, right? Because you're going to go, and so you should have a plan. You should prepare for that.
100%.
Don't get stuck doing death activities. Partying, having it right, like you living in the moment, and then like unfortunately, Mr. Ford's, AJ Johnson's spouse, your family setting up a GoFundMe because you failed to take responsibility.
100%.
And it's not an easy conversation, but if it were easy, right, everyone would be doing it.
100%.
It wasn't easy for me, but you set the bar, right? You set the example for your family, and I promise you they'll follow. The reason why my brother-in-law are having this conversation, because after I got educated and got protection, I got my sister and her daughter at that time, right, protection. Then I got my brother's protection. Then I got my parents' protection. Then my brother-in-law, we talked to him and got him some protection. And so there's a wall of protection around our family. The next generation, right? All of our children have protection, right? My two daughters, his children. And so it's not something that we take lightly, right? Like, each one teach one. And over time, there's a wall of protection around our entire family. And we just want to grow and expand that. And the people that we're able to reach and touch, we want to also offer them that same opportunity to put a wall of protection around your family. Like, that's how you build generational wealth. It's not just through your immediate family, it's through your extended family and those connections, having things in place. Because I promise you, if you're the person that everybody looks to in your family, if somebody, extended family, cousin, aunt, uncle, right, they passed away and they're used to you bringing in the money, they're going to come look at you when they need funds to bury that person. So you can pay, right? Like, I pay for one of my siblings' policy. It's $40 a month. I promise you, I pay that gladly each and every month, because something happens to him, somebody's got to take care of the responsibility. I'd rather take care of the $40 a month than have to figure out how we're going to bury him or cremate him for 10, 15, 20 grand, right? I'd rather come out of pocket $40 every month than have to come out of 15 grand at a drop of a hat. And I didn't just get 15 grand on my brother. I promise you.
100%. 100%. 100%. Again, I appreciate you taking the time, Margita, to come and share this with us. Andres Campos Munoz, I see both of your responses, man. I see the one that you're asking about the pre-trip. Obviously, this ain't the live stream for that. Yes, I don't want to get into that right now, man. I apologize about that. Can you archive this stream? This stream will be public after Margita and I close out here in just a few seconds. All right. So yeah, you'll be able to come back to the channel and see this stream again. Sometimes I do live streams and I don't make them public afterwards. Right. But this one right here has to be public. I can't keep information like this private. Right. Mr. Smuggler says, yes, sir. Appreciate you being here, Mr. Smuggler. Dayton Womack says this was definitely needed. I'm going to do my own research on IUL now, and especially if I decide to become an owner operator. Dayton Womack also says, thank you, Miss Margita, for your wisdom, and thank you, Helpful Trucker, for this post. Absolutely. Dayton. Mama Bear just joining from Southern Cali. Mama Bear, you missed the whole thing. We just about to end up right now, but this will be public when we close out here in just a few minutes. You can go back and watch the whole thing. Margita has shared a lot of information with us. Again, family, go on and take Margita's financial assessment. Click the submit button at the bottom. Submit your information over to her. if you want to know more, if you're interested in maybe taking the next step, or at least just having a conversation. If you're going to have a conversation on this subject with someone, if it's one thing that Majida has demonstrated to me and hopefully demonstrated to you all, that the person that you're talking to needs to be knowledgeable. The person that you're talking to needs to be knowledgeable, and you may not just be able to just talk to anybody about this information right here. So here is somebody right here on the in my family that can help to sort all of this out for you. So I highly recommend, if you don't have protection in place, if you're not, investing in your retirement for the future, if this is kind of where you are, or even if you are and you just want to know more, I'm encouraging you guys to take Majida's financial assessment. Cassandra's 26 joining from Charlotte. I appreciate you being here. Make sure you go back on and check the replay. That's pretty much it. We're gonna close out. Me and Majida got to get going. She's got to grab up her little ones. And I'm working tonight. I'm going back out. I'm about to pull out here at about 9 o'clock. I love being out at night because ain't no traffic and ain't no DOT. So I'm about to head out tonight and grab me up a couple of extra loads. You know what I mean? So it was a good week for me this week. So again, I appreciate you, Majida, and family. Majida will be back on as well. So look for her on the channel here in the future. All right. Thank you, Majida. I appreciate you.
Thank you, bro. Have a good one.
100%. Same to you.